All right, welcome back to the deep dive. Today we are strapping in for a pretty interesting ride into the world of NIO, the Chinese electric vehicle maker.
Yeah, and it's more than just cars, isn't it? It's really about the whole EV race.
Exactly. It's a deep dive into that, high-stakes game of dominating the future of electric mobility and, well, what it actually takes to win. So our mission today, we want to cut through all the jargon, all the noise, and really simplify the latest financial reports and what analysts are saying about NIO for you. The goal is for you to quickly grasp, their key strengths, the big challenges they're definitely facing, and maybe what you should watch out for next. We've looked at a whole stack of sources, investors.com, Barron, Stock Titan, MLQ, Reuters, you name it. We're boiling it down to the clearest picture possible, keeping it simple.
And it's super relevant right now, this deep dive. Because NIO, well, it isn't just some other car company. It's a real bellwether, you could say, for the whole EV market, which is changing so fast. Their story really shines a light on that tension, that pull between pushing for super aggressive growth and finding that path to, well, actually making money consistently.
That profitability piece.
Exactly. We're going to look at how a company can hit record delivery numbers, get everyone excited, but still be dealing with some pretty serious financial hurdles. It tells you a lot about the industry itself.
Okay, perfect setup. So let's jump into the positives first. What's really, sparking NIO's growth story right now? What were the big wins from the recent data?
Well, the headline number has to be deliveries. They're undeniably strong.
Yeah, I saw those. Impressive.
Absolutely. So in August, NIO delivered 31,305 vehicles. Now, just that number might not mean much, but
Context.
right, that's a year-over-year increase of 55.2%. That's huge growth, really eye-catching in such a competitive space.
55%, wow. And wasn't a lot of that driven by the new Onvo L90 SUV?
That's right. The Onvo L90 was a massive part of that surge.
So what was the deal there? Why was it so successful?
That's a great question. It really gets to their strategy. See, the Onvo L90 wasn't just another SUV. It was specifically built to hit a key spot in the Chinese market, the competitive family SUV segment.
Oh, okay.
It had that mix of tech, features, and, importantly, a more accessible price point compared to some of NIO's earlier, more premium models. It's really core to their whole plan for reaching, the mass market.
Got it. So smart targeting, not just throwing cars out there. And it wasn't only August, right? Q2 was also strong.
Yeah, Q2 deliveries were up too. They hit 72,056 units, which was a 26% jump compared to the year before.
Still very solid growth.
Definitely. And they're aiming even higher. The projection for Q3 is an ambitious 89,000 deliveries. If they hit that, it'd be a record. Shows the demand is still there.
Serious momentum then. Okay, but here's something that kind of surprised me a bit, given all that growth push. Improving margins.
Yes. That's the other side of the good news coin.
I had to look twice, but their gross profit margin actually went up slightly, from 9.7% last year to 10% this quarter. And operating and adjusted losses also narrowed a bit.
That's right. Compared to the previous quarter in Q2 last year?
Can you maybe quickly unpack adjusted losses for us? Why is that narrowing important, even if it's small?
Sure. So adjusted losses usually means they've taken out certain costs that aren't part of the regular day-to-day operations or things like stock compensation. It gives you a, let's say, cleaner look at how the core business is doing.
Okay.
So the fact that it's narrowing, even slightly, suggests they're getting a little more efficient. Managing the costs of actually building and selling each car, and maybe their overall operations too. It means a tiny bit more of the money coming in is sticking around before considering those other items.
So that little jump from 9.7% to 10%, it's not just noise. It's maybe a sign that scaling up has started to help efficiency.
Exactly. It could be the start of seeing that operational leverage kick in.
Yeah.
And this is why you get analysts like Jeff Chung at Citi staying pretty optimistic. They see these small margin gains as, baby steps towards eventually getting to positive cash flow in the coming quarters. It suggests the long-term plan might be starting to work slowly.
And the market seemed to like it, didn't it?
Yeah.
Their U.S. shares, the ADRs, they popped up about 3.1% after the earnings came out. Beat the indexes.
Yeah, definitely a positive reaction there, a bit of excitement.
Okay, but you know us, we need the full picture. Keep it simple, but thorough. So let's switch gears. No stories, all sunshine.
Time for the speed bumps.
Let's pivot to the bad. Despite those great delivery numbers, there was actually a revenue miss.
Right, this is crucial.
Revenue grew, but it came in lower than what Wall Street was expecting, and especially their forecast for Q3 revenue was a bit light. So for you listening, this means, well, they're selling more cars, but the total dollar amount wasn't quite what analysts hoped for.
And that immediately makes you ask, why? If delivers are up, why is revenue lagging forecasts?
Exactly. Which leads us straight into the next point, pressure on selling prices. It seems that push for volume for the mass market came with a price tag.
Literally.
Yeah. NIO's average selling price dropped pretty significantly. It was around $38,000 a year ago. Now it's closer to $31,000.
Wow, that's a big drop.
It is. And while that helps move cars and grab market share, it directly squeezed their vehicle margin. That profit they make on each car sold. It's that classic trade-off, isn't it?
It absolutely is. And what's fascinating, or maybe worrying, depending on your view, is seeing the direct impact on that metric, the deteriorating vehicle margin.
Okay, what were the numbers there?
It fell from 12.2% a year ago down to 10.3% now. That drop, it just clearly shows you the result of that pricing pressure and also shifts in which models they're selling more of.
So less profit per vehicle.
Basically, yes. The profit slice on each car is shrinking. And for you, the listener, this really highlights that classic growth company dilemma. Do you chase volume and market share now, even if it hurts margins today, hoping that scale eventually fixes it? It's a gamble.
A high-stakes one. And unfortunately, this seems to have fed into a wider net loss overall.
Correct. The bottom line number. They posted a net loss of around 5.14 billion RMB. That translates to roughly US $717 million.
Still a huge number.
It is. And while it was actually a bit better than some really bad prior quarters, it was still substantial, and importantly, it was more than analysts had expected. The market was braced for a loss, but not quite that big.
Ouch. Okay. So connecting the dots, bigger than expected loss, shrinking profit per car. That leads to cash flow worries.
Exactly. Which brings us to the cash burn and capital needs issue. When a company is negative in cash flow, like NIO still is, it just means, simply put, they're spending more money than they're bringing in from selling stuff.
Like that new restaurant example you used. Busy, but costs are still higher than sales.
Precisely. You're constantly needing to put more fuel in the tank just to keep going and growing. And this is probably why you saw something like Bridgewater Associates.
The big investment firm.
Yeah, they sold off 1.7 million NIO shares back in Q2. Now, you can't read too much into one firm's move, but for you, the investor watching, seeing big players trim positions like that, it often signals some caution, maybe broader economic worries, maybe concerns about these ongoing losses specifically.
So it highlights that constant need for cash when you're burning through it.
Yes. How long can they keep funding the growth without having to raise more money, potentially from issuing more stock? That's the underlying question.
Right. And that brings us to another risk area. Launching these new mass market brands like Onvo and Firefly.
Yeah, the mass market launch risks. Expanding is crucial for their long-term plan, getting into those bigger volume segments, but it's not easy.
How so?
Well, first, they face regulatory hurdles in China. Things can change quickly there, rules around EVs, pricing, incentives. It's complex. And second, there's just an uncertain timeline for when these new, cheaper brands will actually start making money.
And the big number hanging over all this. Full-year profitability for NIO overall. Not expected until when?
The consensus seems to be pointing towards 2029.
2029. That's still quite a ways off. Requires a lot of patience.
A lot of patience.
Okay, so we've seen the highs, amazing growth, those little margin upticks, and the hurdles, revenue miss, price pressure, cash burn, that long road to profit. Let's try to pull it together now. The balancing act. What's the general feeling from analysts? You mentioned cautious optimism earlier.
Yeah, I think cautious optimism sums it up pretty well. Analysts definitely give credit where it's due. They applaud the delivery numbers, the success of Onvo driving growth, those small margin gains. They see the potential there, clearly.
But the caution comes from?
Well, it raises that big question for you, the listener. How do you actually weigh that exciting growth against these persistent, pretty large losses, and frankly, a very long runway to profitability?
It's a tough balance.
It is. Market watchers are definitely pointing to the high losses, the ongoing margin pressure from that competitive pricing, and those regulatory uncertainties we mentioned. They're all significant hurdles. So the main takeaway is profitability still feels quite distant. It requires belief in the long game.
Which makes it super important for you listening to know what you need to watch next. What are the key indicators to keep an eye on to understand NIO's path and maybe even the wider EV market? Let's keep it simple and actionable.
Okay, 4 critical areas, I'd say. First, obviously, Q3 deliveries. Did they hit that ambitious 89,000 target? Hitting targets keeps the momentum story alive.
Makes sense. Number 2.
Second, watch those vehicle margins. Does the pricing pressure ease up a bit or does it get worse? This is absolutely vital for profitability. Selling more cars doesn't fix the core issue if you're making less on each one.
Right, crucial metric.
Third, their cash runway. How much cash do they have? How fast are they burning through it? Will they need to raise more capital soon? That signals their financial health or lack thereof.
Okay, cash is king. And finally.
And fourth, keep an eye on regulatory developments in China. Any changes to EV incentives or rules about pricing, that stuff can really shake up the market landscape for companies like NIO pretty quickly.
Good points.
Yeah.
Okay, so wrapping this all up, what does it really mean for you? We've talked about NIO's impressive growth, their expansion, really exciting stuff. But we've also laid bare the significant losses, the squeeze on margins, that long wait for profit. It's this story of, well, huge potential running smack into some tough economic realities, a real balancing act.
Yeah, and the NIO story really, it just simplifies a core challenge you see across many innovative fields, especially ones needing tons of capital like EVs. How do you scale up super fast, grab that market share while the market's hot without, bleeding cash uncontrollably? It's like walking a tightrope. And sometimes the ugly financial details get hidden behind the good headlines about growth and cool new products.
That's a great way to put it.
It just reminds you, the listener, to always peek behind the curtain, look beyond that initial splash, and really try to understand the underlying economics. Is it sustainable? That's the real question.
Absolutely. So here's a final thought for you to chew on. As you look at NIO, or any company like it, how do you personally weigh that aggressive expansion and cool tech against the very tangible, sometimes boring, goal of actually making money? Especially when it takes so much investment up front. Keep those 4 indicators we mentioned in mind as you watch this space. Until next time on The Deep Dive, keep digging deeper.